Okay, so now we've had a bit of time to digest the autumn statement and what Jeremy Hunt announced to the House just a few days ago. I wanted to just pick apart a couple of things that I think might have been missed a bit on YouTube and specifically aimed at investors. Now, I'm not going to go over all the changes, of course. I think there's been plenty of other great videos out there which have done a really good job. If you do want that, I suppose you want to head over to something like Martin Lewis to do that. And also Damien from Damien Talks Money has done a really good job as well. So I'll link those two videos below. Now, specifically in this budget, I think there are three things in this budget that we really need to pay attention to. And actually, I think are really important. Now, firstly, I think it's important to say that we're probably going to be able to actually invest less over our investing careers if this budget does actually go ahead over the next couple of years. Because of course those tax bands have been frozen. It does mean that any pay rises you get are going to potentially push you into different tax bands and you are going to end up paying more. So you're probably likely, depending on what situation you're in, that you may end up actually being able to have less disposable income, pay more taxes, which will probably mean you'll be able to invest less in the first place, which means these next 2 points are going to be really important to make sure that you're actually able to grow your wealth in the really long term. And here are the two key changes. One of the first ones is dividends allowance. Now, at the moment, every adult in the UK has £2,000 worth of allowance for their dividends every single tax year. And this means that if you did have a portfolio outside of a stocks and shares ISA, for example, that was giving you dividends and you were earning that nicely every single month or every single quarter, at the moment you can earn up to £2,000 before having to pay any tax. Or if you run your own business and you pay yourself through dividends, of course you've still got that £2,000 allowance. Now, what's changing in the budget is next tax year and the tax year after, you're actually going to see your dividend allowance be cut quite substantially. So as it stands at the moment, your dividend allowance is going to get cut from £2,000 to £1,000 next tax year. And then the tax year after that is going to cut from £1,000 to £500. So effectively it's going to get halved and then it's going to get halved again. Now, the third change, which I think is going to affect investors quite a lot potentially, is going to be the capital gains allowance. Now, similar to dividend tax at the moment, as it stands per year, per tax year, you have £12,300 tax-free for any capital gains you make. And that's capital gains you make from any assets you dispose of. Of course, that could include things like your home, a rental property, stocks and shares, especially in our example, anything really of significant value that you make a profit on. Now, again, just like dividends allowance, this is going to be cut pretty much in half next tax year and then cut in half again pretty much the tax year after that. So capital gains tax is going to move from £12,300 to £6,150 next tax year, and then it's going to go down to £3,000 from April 2024. Now, rather than just leave you with those examples, let me just run through the figures actually here on screen now. And I'm going to run through two different scenarios, one that says you earn £30,000 a year and one that says you earn £60,000 a year, just so I can kind of give you a flavour if you're a basic rate taxpayer or if you're a higher rate taxpayer, because of course this is going to depend how much tax you actually end up paying. So firstly, let's just run a capital gains tax example, and I'll put everything up on screen now. So I'll just run through these numbers here on my laptop. So at the current year at the moment, if you had a £30,000 salary and you made a £15,000 gain, this could be from anything. You could be selling a nice piece of art, or you could just be making loads of gains on your stocks, for example. At the moment, you've got a £12,300 allowance, which means anything above that is taxable. So in this example, £2,700 would be taxable. The rate you would pay as a lower normal rate taxpayer, as a basic rate taxpayer, would be 10%. So 10% of the taxable amount is £270. So not too much money, you might think, and that's just the price of doing business. However, if you make £60,000 salary at the moment and you made a £15,000 capital gain, you still get the same allowance. However, your tax rate is going to be a little bit higher. So still £2,700 worth is taxable, but your 20% rate now kicks in. So you'll be paying £540. Okay, so now let's just go to the next tax year, so from 2023 onwards, and we'll see how these changes actually start to kick in. So exactly the same examples, a £30,000 salary and a £60,000 salary. Here's the differences which happen when we reduce those allowances. So now, rather than having £12,300 allowances, we'll just have £6,000 allowances, which now means that taxable amount is going to be £9,000 for both of us, which now means for our basic rate taxpayer, we'll be paying £900, which is quite a lot of money now. And then our higher rate taxpayer is £1,800. So you can see how this adds up quite a lot now, but things get a little bit worse and get even more expensive once we go to the next tax year in 2024. So again, I'll put this up on screen now. So as we can see, same examples, £30,000 salary and a £60,000 salary. We're still making a £15,000 gain, but our allowance is now just £3,000. Therefore, we have £15,000 worth of taxable income on capital gains we're going to have to pay the taxman. So on our 10% rate, that puts us now at £1,200, and at our 20% rate, of course you can work that out pretty simply, is £2,400. So look, the bottom line here is on capital gains. If you have the same £15,000 gain in a couple of years' time, at the moment you'll pay hardly any tax on it, but in 2 years' time you'll pay quite a substantial sum. And I don't know about you, but breaking down £160 a month just for selling something at a different time is definitely a reminder that you need to be really, really smart with your money. But we'll move on to that one in a bit. Okay, now let me just take you through the numbers from a dividend tax perspective. And of course, the percentages are all going to be different. Just as a reminder, guys, I'm not a financial advisor, neither am I a tax expert. This is just figures that I've taken from the government website. Please do your own research and please make sure you understand these things fully, because unfortunately they are quite complicated, which is quite frustrating. So again, in this example, 2 salary bands, a £30,000 earner and a £60,000 earner. Now, let's just say you've made £5,000 of lovely dividends in 1 year. This year, you're going to have £2,000 of allowance, which means £2,000 minus from £5,000 means that £3,000 of that will be taxable. Now, on a basic rate of income, your percentage that you pay a tax on is 8.75%. So on that £3,000 is just 8.75%. So not a huge amount of money, you could argue, and that's £262.50. Now, your £60,000 earner pays substantially more, as you'll see here. Again, same allowances, but unfortunately, they've got a 33.75% rate. So they're paying nearly £1,000. So what's that? Nearly 4 times more in terms of tax rate that they have to pay. Now, of course, you can argue they earn more, so they should pay more, but that's quite a lot of money as it stands. Now, moving on to the next tax year, of course, your allowance is going to be cut in half from £2,000 to £1,000. Again, what this means is that it's £4,000 taxable rather than £3,000. You can see our basic rate taxpayer is now paying £350 and our higher rate taxpayer is paying £1,350. Then a year after, again, we're going to get those allowances cut in half. Now we're at £393 for a basic rate taxpayer, but a higher rate taxpayer is now paying £1,518.75p. Now, what's going to be interesting here, I think this is going to bring quite a lot of accounts in at the moment who aren't necessarily in a stocks and shares ISA, for example, again, which we're going to touch on later, which are going to probably start to have to pay tax on dividends, because at the moment, a £2,000 allowance is quite generous when you think of the size of the account which might take to actually generate that level of dividends. Now, just think in a couple of years' time, a relatively small investing account of say £10,000 in UK dividend stocks, let's just assume they paid 5% dividends per year. 5% of £10,000 is £500. That's pretty much the limit of what you'd be able to actually have without then having to pay tax after that. Now, before, at the moment, if you have a 5% dividend yield, you can get away with having an account size of around £40,000 before you have to worry about any dividend taxes at all. So it's quite considerable what happens in a couple of years' time. So conclusion and what we can actually do, now more than ever, and I can't stress this enough, our tax protected and our tax advantaged accounts like our ISAs are probably going to be the single most important thing that investors can make sure they're using every single year without fail. And I'm actually going to have to review my own investing accounts here because my investing accounts are a bit of a mess and not everything is inside an ISA. Now, don't forget, there's different kinds of ISAs, but ultimately one of the goals they serve is protecting your money and your investments from income tax, capital gains tax, of course, and any of those dividend taxes too. So once that money is inside an ISA, for example, a stocks and shares ISA, that means they're completely protected. So whether you sell that investment in 1 year's time or you sell it in 20 years' time, there's no taxes to pay. Now, on the topic of ISAs, don't forget that every single tax year, you've got £20,000 you can play with. And one thing that hasn't changed, thankfully, in this budget is that allowance. You have £20,000 per tax year that you can stuff into these various different ISAs. So if you want to put £20,000 maximum into a stocks and shares ISA, that's great. Or you might want to spread it across a cash ISA, your stocks and shares ISA, or even your lifetime ISA too. So go on the government website, get yourself familiar with those. And of course, I've got loads of videos too on my own channel talking about beginner investing and the different kinds of accounts you can use. But absolutely make the most of these accounts, because then all of these allowances kind of go out the window and you don't have to worry about selling different stocks and getting involved with the tax man. And if you're a follower of the channel, you can see my portfolios that I do have regular portfolio updates on. At the moment, I've personally got quite a lot of money outside of a stocks and shares ISA. So my Hargreaves Lansdown account, my Free Trade UK dividend portfolio, and my Lightyear holdings, they're all outside of a stocks and shares ISA at the moment, because I was pretty happy with the allowances that you were given in terms of the £2,000 dividend and the £12,300 capital gains allowance. Now I'm going to have to rethink my strategy over the next couple of years and probably start to sell down some of my assets and get them inside stocks and shares ISAs and potentially either rebuy the same thing or decide on a different kind of strategy. So watch this space, but I am going to have to definitely change my own strategy and be really, really careful about how I manage my portfolio moving forward. Now, one thing I would say is you might think, well, I might only breach these allowances by a small amount and it's only a tiny bit of tax you have to pay. But don't just consider the amount that you're paying now. Consider the fact that if it was a few £100s now, that's not just a few £100s that you're giving the taxman now, that's a few £100s that could grow in your account for, at least in my scenario, 10, 20, 30 years plus. So really consider the opportunity cost here. Certainly as an investor, I think one of our first jobs really is to be as tax efficient as possible, because any little fees or any money coming for our accounts is really important to try and keep in there, keep invested, to keep that dividend snowball, or just to keep that compounding effect going if we're a long-term investor and our goal is to just grow our pot as big as possible. Now, one final point I will make is that obviously from the political standpoint, we do have 2 years left of the government, and potentially some of these changes may never come in and they may be reversed. But just like timing the market, let's not bet as investors that these don't come in. Let's just assume they do all the best practices, make sure we use our tax advantaged account. So whatever happens and whatever government comes in, hopefully they won't remove our stocks and shares ISAs from us, but that could be another issue entirely. Anyway, again, if you're looking to get started investing, don't forget to check out all of my beginners videos for investors. And also, if you're looking to open up the stocks and shares ISA, don't forget I've got all of the latest offers and links in the description below, so do check those out. But anyway, thanks again for watching. Drop me a like on the way out, subscribe for more, and as always, happy investing.